Home builders moving sharply higher Friday after Fed Chair Jerome Powell opened the door to potential rate cuts as soon as September. The group is up more than 10% so far this year. But today, some of the biggest U.S. names in the sector are giving back a bit of those gains. The question now, will Powell's signal be enough to jumpstart the housing market? I want to bring in Brett Ryan, Deutsche Bank senior U.S. economist, and Daryl Fairweather, Redfin chief economist. So, Brett, let's start with you here. Markets are pricing in that 25 basis point cut in September, and you see a total of 75 basis points by year end. How much could that translate into broader economic support here? And specifically, how much relief can it provide to the housing market, which we know is so closely tied to the consumer?
Sure. Thank you for having me in the program. And we did bring our call forward. We expect 3 rate cuts once a quarter. As Powell said, though, we think it's going to be a slower pace every other meeting as opposed to consecutive meetings. So the feed through into the housing market may not be as dramatic as basis point, for example, in terms of rates. And one of the reasons why is we think 10-year rates are going to remain high, and that's because of term premiums. So even though the Fed's cutting 75 basis points, that may not translate into an exactly 75 basis points reduction in mortgage rates. They may remain somewhat elevated. They'll come down a little bit, but maybe not, probably not the full 75 basis points that we expect. So conditions still a little bit restrictive.
And Brett, that's a great point. Daryl, I want to bring you into that conversation as well, because a lot of people think a Fed cut automatically means lower borrowing costs, but it is more complicated than that. And we actually did see mortgage rates rise after the last Fed cut. So what drives the disconnect? And with rates now at a 10-month low, how much do you think a September cut has already been priced in?
Mortgage lenders are very quick to react to any changes in the market. So we're already seeing that mortgage rates are significantly lower than they were just a few weeks ago. And that even changed on Friday when Jerome Powell was talking about how unemployment is more of a risk. We saw mortgage rates drop. And the spread between mortgage rates and treasury yields is tightening, which means that there's even more room for rates to drop if yields on treasuries stay high. So I think there's a lot of reasons to be optimistic. And if you are a home buyer, I would definitely go talk to a lender this week and find out what rate you can personally get, because the rate that you see advertised is not necessarily the rate that you will get. If you have a great credit score, then maybe you can get an even better rate.
And given where rates are today, how much has that moved the needle when it comes to affordability? Are you seeing any signs that it's bringing more buyers back into this market?
Buyers are incredibly rate sensitive. It's the thing that they watch. It's what affects how expensive their monthly payment is going to be. So anytime that rates move, we do see buyers reacting. And now buyers are getting a little bit more motivation to go look at homes. It's the end of summer. It's not the most popular time to search for a home, but it's also a time when a lot of sellers are getting nervous that they haven't gotten any offers yet. So it could be perfect timing for somebody who wants to come in under asking price and get a slightly lower rate than they would have been able to get earlier this summer.
Now, Brett, this is a question I've been thinking about, because millennials, first-time home buyers, they're having to wait a lot longer to enter the housing market. How does that shift in behavior, more renting, less home equity, impact or maybe could impact the broader economy over time?
Sure. So I think the first place to start is the supply of homes for sale. And as Daryl pointed out, sellers are getting a little bit more nervous. A lot of those sellers are baby boomers that are downsizing, and those homes they have a significant equity saved up in them. So what you're seeing is the month supply of homes for sale at the current rate. That's they've been ticking up recently. Median new home prices are down, let's call it on average, about 2.5% year over year. And you're seeing existing home prices also dipping, approaching flat year over year. So discounts are starting to come back into the market as people start to need to move inventory. And I think that's part of the story, as Daryl pointed out, along with rates. And that could be an important part of the story as well in terms of bringing younger generations into the home market that have really been boxed out by high rates over the past few years.
So then, Daryl, how do you address this affordability problem over the long term? Do you see this becoming maybe more of a federal policy issue? And have we seen any successful government interventions in the past?
There is a bill in the Senate right now to increase the supply of housing, but the most important things are happening at a local level. California has made it easier to build dense housing, and hopefully they keep making progress on that front. Other states have made it easier, like Florida and Montana. So I think what could be different this time around if rates drop is that it's not just going to be an increase in demand for housing. We could also see an increase in the supply of housing, which would be a really welcome improvement from the last rate cycles we've seen.
And to that point, we did receive new home sales earlier this morning. The demand for new homes was stronger than Wall Street anticipated in July, so a sign of maybe some resiliency in housing, even with all these affordability challenges. But Brett and Daryl, thank you so much for your insights. Appreciate it.